up, audit fans? Dr. Amanda White here with the video on ASA ISA 540, which is about auditing accounting estimates. Now, this is actually a really huge standard. If we look here at our table of contents, and I'll just zoom in so that you can see, we've got our general information about the introduction, and that's 23 paragraphs, but look down here. So what we see in the explanatory material is that there's a significant volume about implementing all of our requirements up here. So I'm not going to talk about the explanatory material, but it's definitely worth looking at if you're auditing accounting estimates, to the fact or to the point where it even goes over the page onto the next section. So the explanatory material for this standard is actually longer than the actual standard itself. And so I really recommend making sure that you have a read of that. Of course, if you are an international student, then we do have conformity. So ASA and ISA 540 essentially say the same thing. So this video is perfect for you as well. Let's look at what the standard actually says. I'm just going to scroll down a bit. And the standard says, well, we're dealing with our responsibilities relating to estimates. And remember, there are lots of things that are accounting estimates. So it says here, some financial report items can't be measured precisely, only estimated. And you might think, well, when that comes to mind, you might consider intangibles. Right? That's definitely a big estimated item. But then even something as simple as prepaid assets and uses of those assets or depreciation is actually an estimate. So there are lots of things that fall into this group of accounting estimates. Some things will be easier to calculate, maybe like prepaid assets or depreciation, and some will be much more complicated. Now, if we look, we'll zoom in a little bit more here. There's an important sentence here. The measurement objective of accounting estimates can vary depending on the applicable financial reporting framework. Now, most countries around the world are using international financial reporting standards. In Australia, we call those our AASBs. So we're mostly following the same rules and regulations, but it's important to make sure that in your jurisdiction, you look at the specific accounting standard around estimates. Now, what happens if things are different? The difference between the accounting estimate and the amount originally recognised is not necessarily a misstatement. So you might make a report of something and then need to re-estimate it later. That's not an intentional error, but it is something that we will need to consider. So let's start with looking at our definitions. And these are important so that we're all on the same page in terms of terms. So an accounting estimate is anything that's an approximate, right? And there's no precise means of measurement. So it's not like a sale where you see the good leave and the money comes in. It's more like inventory, where you have product cost. So for example, with inventory, product cost equals direct materials, direct labor, and overhead. So in product costing for inventory, the direct materials and direct labor are easy to calculate the exact figures for. However, it gets more complicated when it comes to overhead allocation, which is where we do a lot more estimating. There's no hard and fast rules. We're estimating based on what we know. So what we're trying to do when it comes to an estimate is I'm trying to come up with an estimate or a range that I think is appropriate, and we're going to use that to evaluate management's estimate. So management put an estimate, and they put an estimate essentially in their income statement or in their balance sheet. The things that they list will be estimates, and we're trying to come up with our own to compare. Now, there is some uncertainty, so we have an actual term for that. Estimation uncertainty is the susceptibility of an accounting estimate to inherent lack of precision. So that could be because of particular assumptions that might be made, but there is always going to be uncertainty. Management may be biased because they obviously have incentives to make the accounting data look a particular way. So we need to really consider that quite carefully. So let's look at the requirements. And this is exactly what we have to do. So I have to first look at risk. Right? When I do my risk assessments back in 315, then I also need to consider risks around accounting estimates, because anything that's an estimate has an increased possibility of misstatement because of the professional judgment nature. All right? The fact that we are making a judgment and it's not an exact science means that there's increased risk. I need to think about, what do the accounting standards say about risk? How does management identify areas that might need to have risk? Do they have some sort of policy in place, any sorts of procedures? Then we're going to look at, how do management actually make the estimates? And we're going to go into quite a lot of detail when it comes to estimates. We're going to look at the method. What are the models that they use? Is it a model backed up by research? Is it something they've designed themselves? What are the controls around making an estimate? Who has to check it? Who has to confirm things? Did we use an expert? And remember, in the 600s series, we talk about using experts. The next one is key. What are the underlying assumptions? So how do they use, and these assumptions, remember, will come from the model, or they'll feed into the model. So we have to look at, what are those assumptions? Did they change from the prior period, and why did they do that? And how has management assessed the uncertainty? So if they are making professional judgments, perhaps have they considered a range? Have they benchmarked themselves against other companies in the industry to determine whether that's appropriate or not? So I have to look at all of these assertions, and I have to look at the accounts. So I have to review the outcome of the accounting estimates. So I need to think about, have we looked at all the information to actually assess this? So we go back to the method. Are they using the right method? Compare this to our other clients. What are the controls? Did they use an expert? Underlying assumptions. And if we think these assumptions need to be different, the auditor might actually need to create their own model. All right, and so we can create our own model to generate our own estimate to compare to what the client has actually put together. Now, in terms of risk, again, as part of ASA 315, I have to consider, are there any risks from this? Quite often you will see estimations identified as significant risks as part of the audit process and the planning process, which means that there's going to be increased effort placed in auditing those areas. And that could be more senior staff, it could be more time. So where I think that there is more uncertainty, all right, then I'm going to consider implementing more effort. Now, based on the risk, and if it is something that is quite risky, then I do need to do a few things. Have they applied the right accounting standard? That's the first one. And then let's look at their methods and determine whether that method is actually appropriate. So going back through again the model, the assumptions, etc., to determine whether that's okay. Now, we might test how management made the estimate. So we could look at two different things: the method of measurement used and the assumptions. So we will do two things. The first thing that we're always going to do is check management's calculations, all right, when it comes to assumptions around, when it comes to management and their estimates. So we're going to go through and use their exact model and check management's calculations. The second thing we're going to do is develop our own estimate. So that might mean using a slightly different model if we think a different model is appropriate, using different assumptions, and then comparing these two to see, well, do they say the same thing? And then compare that. So that's what it says down here. We need to develop an estimate or a range of estimates to compare to what management have prepared. Now, what happens, and of course, if we do think that there is uncertainty, or we do think there is a difference, we will bring that up with management. We also have to consider estimation uncertainty. So where there is many perhaps models or many assumptions, I have to ask, did management consider an alternative? Did we consider an alternative? We will probably highlight these alternatives when we're developing our own model. We have to look at whether management's assumptions are reasonable. Do they make sense? Is it similar to other assumptions made by other firms in the same industry, to decide whether there is any estimation uncertainty. Now, we also have to look at recognition and measurement. So if there is an accounting estimate that is a significant risk, I need to get evidence about whether we've recognized the accounting estimate and that measurement. Again, that links back to those other things about checking the model and then checking the assumptions to make sure that they all match up and are saying the right thing. So after doing all of that, I have to look at the reasonableness of the estimates. So I compare the evidence collected from the client, our own estimates, to see whether they are reasonable. I also need to look at management disclosures, because remember, most accounting estimates will need to have note disclosures about how they are calculated. So we need to look to our IFRS or to our AASBs to make sure that those note disclosures are appropriate. You might need to employ a firm expert. Now, of course, you also need to consider the possibility of management bias, and we know that agency theory will come into play here. This is sort of like a tacked on one, but when you're considering how management makes their assumptions and chooses their models, we have to consider the possibility that they're choosing one in particular. If we've had discussions with management, we need to ask to get a written representation that they confirm everything they've said verbally, and then we need to document that all within our working papers. Now, one thing that's not here is that we may also need to consider whether any of these estimates might form key audit matters under ASA ISA 701. So where there are high levels of uncertainty within the estimate, we may need to also include it in the key audit matters. So that's it for ASA ISA 540. If you have any questions, please pop them in the notes. I really recommend reading the explanatory material. If you have any questions, again, post them in the comments. You can catch me on social media, and I will see you next time.